Okay, then with this video, then I'm going to discuss about the specific deductions in business income calculation. So then what we have discussed so far, right, under the business income, so the section 10 and 11 we have discussed. So then we have to start with the specific deductions. There are some specific deduction, that means the specific expenses are need to discuss how we can treat on the taxation regarding those specific expenses. So here then first I will discuss section 12, that is regarding the interest expense, and then the section 12 need to discuss together with section 18, right? So that is what so deductible amount of finance cost, section 18, and then section 18. Thereafter we have to discuss then section 12 we discuss, then 18, then section 13, that is regarding the allowance for trading in stock. So there is cost of sale. Thereafter section 14. So section 14 for repair and improvement expense. Thereafter section 15, research and development expense and the agricultural startup expense, R&D expense, research and development expense, as well as the agricultural startup expense. So then section 16, there is a very important things we need to discuss. The capital allowance and the balance in allowance, that is very important. Capital allowance and balance in allowance. And the finally section 18 we have discussed. The 19, the business or investment loss. So these are the specific deductions that we need to discuss under the business income. So then I will select first one as section 12 and 18. So section 12 discuss the which nature interest expense you can deduct as an expense, the nature of the interest. So nature of the interest. So that means the section 12 not deal with the amount. So amount, how much you can deduct as an finance cost, how much you can deduct as an interest expense, it will deal with the section 18. So interest expense, then here I discuss the section 12. That's a very small part, right? So but very important. So there is the interest expense, because the interest is because of the debt, loans. So debts can be taken into two purposes. One is if that debts are used for any personal purpose. Other one is used for any kind of business purpose. So under this business purpose, my dear students, so that business purpose you can use for, one is working capital requirement. The working capital requirement in the sense, there's a working capital requirement. So the working capital requirement mean the fund requirement for the day-to-day activities. For an example, to purchase inventories and to pay salaries to workers, likewise the day-to-day activities. So other one is obtain business asset or depreciable asset. The asset obtained under the any kind of the debt, the lease for the purpose of use of the business, that is a depreciable asset. So if there is any loan proceeds used for the personal purpose, that interest paid on that loan proceed is not a allowable expense. That means there is a disallowable finance cost or the interest cost. If you use any debt for personal use, and then if there is an interest on that debt, you know that is a disallowable. But if you use any business purpose, my dear students, there is an allowable. Therefore you can deduct that interest expense as an expense as per section 12. But the thing is, you know this nature of expenses is allowable, but you don't know how much is the allowable expense. How much? Then how much? So how you can decide that? Then you need to use the section 18. So section 18. Section 18 is what? Allowable finance cost. So how you can find this? So allowable finance cost, you have to take the finance cost allow under section 12 divide by debt capital at the end of year of assessment into 4 into equity. So 4 into equity. So my dear students, the 4 into equity, when you when you take this equity, please keep in mind, the revaluation reserve also part of equity, but for this taxation purpose, a revaluation reserve should not take. So under this restriction ceiling, this is the maximum amount you can deduct as a finance cost, right? So if there is any expense, interest expense which is not used for the business purpose, that is disallowable. Then if all the interest expense are disallowable, then no need to go with the section 18. But if there is an interest which is allowed under this business purpose, then you need to calculate the maximum amount, how much you can deduct as an expense from the business income. So that is the application. So other thing is, my dear student, keep in mind, due to these restrictions, right? Due to these restrictions, if there is a disallowable finance cost, you can carry it forward for another 6 years under a same limitation. So what is the same limitation? As always, you need to apply this formula. As always, you have to apply this formula. So that is the application of section section 12 and section 18. So we have given some example. You can read the examples, right? Once you got then you can see the tutorials, right? So you can go through that very easily. You can understand that. So in this case, so the company B, garment factory, incurs the interest expense amounting 2.5 million during the year of assessment 2023 and 4. The financial position of the company as at 31st March 2024 revealed as follows. That means the stated capital is given, the 5 million, the reserves 3 million, and the long term loans is 40 million, right? Then you're supposed to calculate the disallowable finance cost if there is any available. So we'll see how we can calculate this, right? So in this question, they have nothing given whether the interest expense incurred for the business purpose or not. So therefore we have to assume these expenses are incurred for business purpose. Otherwise, then in the question of the examiner clearly should mention that the purpose of obtaining that loan proceeds. So however, this 40 million loan is totally for business purpose. Therefore, there is no any disallowable finance cost under section 12. So then we can therefore the total finance cost of how much 2.5 million is for section 2 under section 12, that is allowable section 12. Therefore we have to calculate the allowable finance cost. So the finance cost allowable under section 12 divided by debt capital into 4 into equity, 4 into equity. So the 4 is the 4 absolute value, right? So here the 2.5 million rupees in 1000 is the interest. So the loan is given at the end of the year of assessment 40,000. So into 4 is 4, you know, that is absolute value. So the equity, when you take the equity, you have to take the stated capital and all the reserves other than that, excluding revaluation reserve. Here in this case nothing given about the revaluation reserve. So total equity is 8 million. So now you know when you calculate this. So what is the value? 2500 divided by rupees in 1000, 40, and need to multiply it by 32. So that is 2000. This is the maximum amount that you can deduct. But you here then you can calculate the disallowable finance cost. So how much the disallowable finance cost? How much you have already deducted? That is 2500 from accounting profit, but for tax purpose that is only allowed 2000. So disallowable part is 500. So how you can adjust this? You know this is the structure of calculate the business income, right? So plus and minus. So under that case, you know the profit before tax. Let's assume this 1750, that means rupees in 1000, right? So when you calculate this 1.75 million, you already deducted 2.5 million as an expense as per tax, so as per accounting. This accounting profit, right? But for tax purpose, you know the maximum limit is only 2000. Therefore, that 500 you need to add back as what? Disallowable finance cost. Disallowable finance cost. You have to keep in mind. Therefore, you have to consider that one, disallowable finance cost. So you know that if there is a disallowable finance cost due to these restrictions, so you can carry it forward. You can carry it forward this unclaimed 500, unset of 500 for next 6 years. 6 years, 6 year of assessment. So under the same condition, you should know, right? Here then you can calculate the assessable income from business is, you know, right? 2250, here no value. So here you can see 2250. That's how you can get the total, not total, you can take the assessable income from business, right? That is the application of section 18 and 12. So now we can focus into the allowance for trade in stock, that means the cost of sale under section 13. That is very easy. Why? What we discussed that means when we calculate the taxable profit, we should know what are then how we can treat some expenses. That's what we learn, right? So section 13, section 13, you know the allowance for trade in stock. So here the taxation, they have given the way of calculate the cost of sale. This is another way, cost of sale. So how you can calculate that in the same way in the accounting, right? You know that value of opening stock of the inventory plus purchases, then you can minus value of closing stock. These are the way of calculate cost of sale for accounting as well. So this is what the allowance for trading stock, otherwise the cost of sales. Right. So this is how we can do that, right? So in this way you need to adjust your cost of sale. So if the examiner in the exam, if they given something something including your cost of sale other than these values, so you have to adjust accordingly, which relevant to the taxation, right? So this is the way. That is very easy. But in your past papers, never testing this adjustment until the last exam, right? Because the accounting treatment, the tax treatment for the trading stock is similar in this case. So then we can discuss. Then I will skip for a moment section 14, because then we have to discuss the section 14 once we discuss the section 16. Therefore then I will skip that one and I will go with the section 15. So section 15 is something like, the research and development and agricultural startup expense. My dear students, as per section 11, that is general main deductions. So we discussed that if any specific deductions allowed to deduct capital nature, otherwise the capital nature, any capital nature expense is not allowed to deduct as an expense under the section 11. So here the way I have discussed that, my dear students, the research and development agriculture startup expense, regardless whether capital nature or revenue nature, that means any kind of research and development or the agricultural startup expense you can deduct as an expense. So regardless capital nature or revenue nature, you can deduct the research and development and the agricultural startup expense as an expense when calculate the taxable profit. So but please keep in mind, under that research and development expense, my dear students, if there is any capital nature expense, then I told that any capital nature you can deduct, but other than the capital nature expense which incurred for acquisition of laboratory equipment. That means, my dear student, for the research and development you may require some laboratory equipment. So my dear student, please keep in mind, if you incur some capital nature expense on the research and development laboratory equipment acquisition, you cannot deduct that expense as an expense. But any other capital nature other than the acquisition of the capital nature under this section 15, you can deduct as an expense. You have to keep in mind that, right? So that is the application of particular section 15, right? 15. So any doubt? May not, right? So then I will discuss section 16. These are not an hard things. Then I will discuss these things again when we are following the past paper questions in the practical questions. So then I will explain these things again and again, right? Then we can discuss section 16. The section 16, you know, there is a, then we introduced that the section 16 is a, so before that then I will forget to discuss one thing is what? Then there is a new section, you know, the section 15A. And I forget to tell that in the early as well, right? Section 15A. The section 15A is, my dear students, there was no, earlier there was no any section for this one, right? After 1st April 2021, there is a, right? There is a new section 15A, right? That advertisement and communication expense. Advertisement and communication. So in that advertisement and communication expenses, they have defined, then you can see in your tube, they have defined what is the meaning of the advertisement and communication expense. So here what you need to understand is, my dear students, here actually the correct name, it is better to use the not advertisement, it is better to use what? The marketing, right? Right, marketing. Right, marketing and communication expense. So marketing, alavikarani in singular, right? So you know the marketing. So the marketing is a broader concept, that means the marketing, right? So you know that I will not going to discuss that one because you are aware about that thing. Advertisement is part of marketing. So if there is in 15A, discuss what? The marketing and communication expense, or regardless of what? Same as the fifth section 15. Either revenue nature or the capital nature, you can deduct the marketing and communication expense which incurred for the business purpose as an expense. But if there is any marketing and the communication expenses which is not relevant to a production of business income, at that time you cannot deduct. But my dear students, if that marketing and the communication expense is the extent that incurred for the production of the business income, regardless either revenue or the capital nature, you can deduct from business income. So there is a new part that we need to discuss under this section 15A. So earlier there was no such section, therefore the any communication and the advertisement expense, if there is any business income generation and if it is a revenue nature, then only they allow. But now there is another nature, that means that if that is a capital nature, that also you can deduct as an expenses under section 15A. Right. So then we have to discuss the major section. So this is very important, section 16. The section 16, you know, the capital allowance and the balance in allowance. So the capital allowance and balance in allowance, then I will discuss first the balance in allowance, capital allowance, then I will discuss this balance in allowance later. So you know, under the accounting basis, you all are very familiar with the accounting, then I will explain this by using this way. This is a tax basis. You know, my dear students, in accounting you discuss that you calculate a depreciation, but for taxation we are not called that as a depreciation. Instead of that we will discuss the capital allowance. What? Capital allowance, right? Capital allowance. So what is the difference between these things? These are not equal sometime, but sometime will equal, but there is a difference. Then what is the reason for this one? You know, under the accounting, what is the relevant standard? LKS 16. So as you all are very familiar with the accounting standard LKS 16, then I will ask a question, what? So in that standard, anywhere, then have they discussed the depreciation base or the depreciation rate? Have they discussed depreciation rate, or otherwise we call that as an useful lifetime. Nothing. In the standard allowed to decide the depreciation rate of the useful lifetime, what? Management judgment. The management can decide what is the expected useful lifetime of that particular asset by using some of the the factors, the expected usage of that asset, the obsolescence, and the the expected the technology advancement, the government decision, like that, different factors which impact to decision of this useful lifetime. Therefore, the standard, nothing given about the particular depreciation rate of the useful lifetime. That means, in the sense, my dear students, let's say there are two companies A and B. There is a motor lorry which capacity everything is same, but they depreciate the two motor lorry based on two depreciation rate. For an example, company A will depreciate based on 20%, but the company B 25%. So what is the reason for that one? That is based on the management judgment, and there some factors how impact to that particular motor lorry. But my dear students, in the capital, when you calculate the capital allowances, you have to use the section 16 of Act number 24/2017, which Act implemented after 1st April 2018. So what is the treatment before 1st April 2018? This is after. So if it is a before, then before you have to go with Act number 10 of 2006. There was old act. Therefore, then all these act clearly define what is the particular useful lifetime of particular asset. What is the relevant useful lifetime of particular asset. That is the difference. Why? For the tax purpose, the management cannot decide the useful lifetime of particular asset, because that has already defined in the particular act. So, but in accounting, the standard, nothing given about the useful lifetime, because they given the guideline how to decide the useful lifetime. That is totally based on the management judgment and the experience and all. So because of this rate or the useful lifetime difference, the calculation of the depreciation also different. Not only that, in accounting, there are many methods of basically we know there are the popular three methods of depreciation. What are those three? The straight line. Other one is a reducing balancing method. Other one is the production unit method. But for the tax purpose, there is no such different capital allowance calculation method. There is only one method, that is what? A straight line method. So because of this depreciation method also, the calculated depreciation and the capital allowance may be different. So there is another one. So the accounting depreciation, you need to calculate the accounting depreciation from the asset which bring the condition where that is available for use. That means if that particular asset, if the date from the asset available for use, you have to get the depreciation for the timely basis. That means, for an example, let's say you acquire an asset and ready to use from 1st July. So my dear students, the year of assessment, let's say 1st of April to 31st March in 24, here 23. So 1st of July mean, in sense, then you have already 3 months gone. Then how many months you have to get the depreciation? For 9 months for accounting, only 9 months. But for tax purpose, my dear students, irrespective that means disregarding the date of the purchase, you have to get the capital allowance for whole year. Then you have to get the capital allowance for whole year, right? Whole year, without considering the date of the purchase. If that particular asset purchase, you have to calculate the capital allowance for whole year. But when it's come to the disposal of asset, in accounting, you have to get the depreciation from the beginning of the year to disposal date. But for tax purpose, if particular asset disposed during the year of assessment, that asset are not entitled to get the capital allowances. So due to these differences, due to these different applications, different practices, the accounting depreciation and the depreciation for the tax purpose, that is what capital allowance is different. So how you can calculate this capital allowance? In the act they have defined like that. In the act, they have defined like that. The depreciation of the capital allowance should be calculated A divided by B. Capital allowance equal A divided by B. Here the A defined as what? The depreciation basis of the asset at the end of year of assessment. So B, the B equal the number of years, otherwise that is a useful life. So this is the way you can calculate the capital allowances. So when you decide the useful life, then you cannot decide that. You mean the management cannot, or the accountant or the manager cannot decide this one. This has exactly given in the act. So when you get this number of years, the depreciation base, the base is, it can be cost or revalued amount, whatever the cost plus subsequent cost, likewise, right? That under the account is exactly given in the act. So when you decide this number of years, you have to be very careful. Number of years. So because when you decide this number of years, my dear students, you have to check what is the year of assessment, which particular asset purchase or acquire. So if that particular asset acquire before 1st April 2018, you have to follow the number of years given the old act number 10 of 2006. But if you purchase or acquire that particular asset on or after 1st April 2018, so you have to refer Act number 24 of 2017, useful lifetime given. So we'll see how what are the now useful lifetime given in different act, right? So as per the new act number 24 of 2017, which implemented after 1st April 2018, then you can see in your tute they have given 6 classes. Then I will summarize these six classes. the keep in mind in these 6 classes is not an easy task, but in class 1 you know the number of useful time is 5. Then how you can convert the number of useful time, useful lifetime to percentage rate, depreciation of the capital allowance rate. So if the number of lifetime is 5 years, then how you can convert 100 divided by 5, that is 20%. If the useful lifetime is 20 years, then 100 divided by 20, the rate will be the 5%. If the number of years 2, you know 100 divided by 2, then it will become rate as 50%. Likewise, that is a basic understand how you can convert the useful lifetime into the particular rate. So the class 1 number of years is 5, class 2 that also 5, class 3 that also 5, that means 20%. But in the class 4 there is a built-in structure and the similar works. You know the number of years 20, that means the rate is 5%. So the class 5, the intangible asset is excluding goodwill, right? The actual useful lifetime of, if that is indefinite useful, you know the when you come to the intangible asset, LKS 38, you know there are 2 types, definite intangible asset and indefinite. So definite means you know exactly what is the useful lifetime, but for indefinite you don't know. If there is an indefinite, you have to assume there is an 20%, 20 years for taxation, that means 5%. So other one is the class 6, the milk in machinery, which latest technology used to manufacture local liquid milk related product, you know there is a number of years is 2, that means the capital allowance rate is 50. So then I will summarize this discussion in a very simple way. Is for an example, please keep in mind in this way. If any building, this here we discuss any asset, acquire or the purchase, acquire, construct or purchase on or after 1st April 2018. So if it is a building, you know the if it is a building 20 years, that means you know rate is 5%, right? 5%. So next one, if it is a machinery which used for milking product, so number of years is 2 years, so percentage is 50%, right? So third one, any intangible asset other than or the excluding goodwill. My dear student, you know goodwill is not an intangible asset because that is internally generated as per LKS 38, but then you may learn under the FAR, the goodwill is an asset for what? The goodwill considered as an asset for consolidation. Other than that, that is not an asset. That's why we exclude it. For intangible asset, you know, for that intangible asset, we can divide into 2. The useful lifetime is indefinite. Other one is definite. If it is definite useful lifetime, the examiner should given that definite. So if it is a definite useful lifetime, so you know my dear student, definite useful, use that useful life given. Otherwise, if it is indefinite, you cannot decide at that time, please take that as an 20 years 5%. So you know, other than all these three, all other depreciable asset, you know, that is 5 year, my dear student, 20%. All other. Here can include motor vehicle, furniture, equipment, fixture, machinery which you not use in the milking product, anything other than this building machinery which used for the milking product and the intangible. All the other depreciable asset, you know, this capital allowance is only applicable for depreciable asset. Only applicable for depreciable asset. So depreciable asset in the sense, you know, the asset which used for the business income production, right? Depreciable asset, this capital allowance. So you can get the capital allowance for depreciable asset. That means, you know, simply the asset which used for the business purpose. So this is how you can calculate the depreciation or the capital allowance for tax purpose. Any asset acquire, construct or purchase on or after 1st April 2018. So if it is on or before, so not on, actually before 1st April 2018, you have to use the plant and machinery equipment 33.33, that means under the construction industry, that is 33.33. If it is export, that is 50%, other 33.33, motor vehicle and furniture 20%, any qualified building, you know, the constructed, that is 10%, then the software imported, that is 25%, the software developed in Sri Lanka, that is 100%, you know, the information technology equipment, the calculating equipment and accessories, you know, the computers like that, 25%, any intangible asset other than goodwill, so 10%. That is those are the rates given in the earlier act number 10 of 2006, which acquire or the purchase or the construct before 1st April 2018. So my dear students, let's say there is an asset which purchased in 2017-18, that means before 1st April 1st April 2018. So what is the rate you have to use? Then you have to use the rate given under the old act, right? Old act throughout the useful lifetime. Then you cannot mix with this old act and the new act. Then don't think up to 1st April 2018 you need to use the old act, thereafter you need to convert into the new act. So that is not the correct method. So once you decide the particular useful lifetime or the depreciation rate throughout useful lifetime of that asset, you have to use the particular same asset. So that's how you have to calculate the capital allowances. So then I will let you know then how we can do this by using one example, right? So this should be an, you know, this only for this capital allowance only for depreciable asset. So then I will do an example how we can calculate this. So examiner give the information like this. So let's say the land is given, this is the acquired year, acquired year 16-17, right? This is the acquired year of assessment. The cost is, let's say, 10 million. Alright. So there is another motor lorry which was purchased 18-19 for 2 million, and motor van which used for the business purpose, right? Which used for the business purpose, let's say 20 and 21, so 7.5 million, and the motor car used by CEO for his traveling purpose. This is a new one, so 21, so 20, 3 and 4, this is the during their assessment, so 8 million. So there is an equipment which purchased 22 and 3 for 1.5 million. Then there is a machinery which was purchased 20 and 21 for 900,000. And let's say there is a building 1 and there is another building 2. This was purchased in 1718 before 1st April 2018. Here after that 21, 21, 20 and 21. Here let's say 1.2 million. Here something 4 million. Then now you are supposed to calculate the capital allowance. Capital allowances for this particular company. Capital allowances. How you can calculate? So first of all, the land. For land, no capital allowance. Why? No capital allowance like depreciation. The land is unlimited useful lifetime. No need to do that. So second one, motor lorry. The purchase year is important. 1819. That means before 1st April 2018. So you have to use the rate given in the new act. Motor lorry. Then you need to calculate. Then you know the new act is given 18 to 19. That is a new act. For motor lorry, you know the any other asset. The motor lorry is the what is the class? You can see under the new act, the motor lorry consists of what? Class 2. The class 2. If it is a class 2 asset, you know that should be the maximum number of years you can take 5 years. The 5 years in the sense, now you know my dear students, the asset which purchase you have to get the fully capital allowance 1819, then 1920, then 20 and 21, 21 and 22, then 1, 2, 3, 4, 2 and 3. Now we are in 3 and 4. So can you take the capital allowance for this year? No, can't, because you have already take the total capital allowance. You can only take for 5 years for this asset. The 5 years you have already claimed. Therefore, for 2023 and 4, because we calculate the capital allowance for 2023 and 4 here already fully claimed. Why? So from the year which you purchase, you have already taken the capital allowance. Therefore, there is no capital allowance to take this 2024 and 3 and 4. So motor van. The motor van also come from the class 2 which was purchased after 1st April 2018. So you know how many years? The 2020 and 21 1 year, 1 and 2, 2 and 3, 3 and 4. Then here we are in 3 and 4. This is the 4th year. Therefore, you can take, that is what, if you want you can divide by 5, otherwise multiplied by 20%. Then now I told you how to convert the useful life number of years into rate. So here how much? 750 and 1500 rupees in 1000, right? So thereafter, so motor car used by CEO. So here you know capital allowance only can take for a depreciable asset. This is not a depreciable asset because this is not a asset which used for the production of business income. Why? This car used by the CEO is traveling. Therefore, here you have to write down capital allowance not eligible. Why reason? Because to get to eligible the capital allowance, you know that should be a depreciable asset. This is not undepreciable because this is used for the traveling purpose. So if there is any asset which used for the other purpose, the personal purpose, so the traveling purpose, then you cannot take the capital allowance because that is not come under the scope of the depreciable asset. So the equipment which was purchased 2022 and 3, that means after 1st April 2018, you know the equipment also come under the, you know, there is a class 2. Class 2, that means 5 years. 5 years in the sense you have to get the capital allowance for 2022 and 3. Then this is the 3 and 4. So this is the second year. Therefore 5%, 5 year of 20%. So here you know 300. So the machinery. That's also after 1st April 2018. You know the machinery also come under. So that is come under class 3. Otherwise you can keep in mind the way I teach you in a building 20 years old 5%. Intangible, if you know the definite useful life, use that. Otherwise 20 years old 5%. The milking machinery, you know that is what 2 years old 50%. Otherwise any other depreciable asset, you know that is 20%. So here also 20%. So my dear student, you know this purchase 20 and 21. So 20 and 21, 21 and 2, 2 and 3, 3 and 4. Here, this is the fourth year you can take. You have to get the count. Otherwise, then you can apply some of the situation where like this. Even though you have already fully claimed the capital allowance for the particular useful lifetime, you may calculate the capital allowance for year of assessment 2020, 3 and 4, because we always, our year of assessment is 3 and 4. Right here, 90 is 180. Right. So it's the built-in one. So 17, 18 mean that it is before. This is a before. This is a before. Right. Before 1st April 18. That means you have to use the old act. Therefore, old act given for built-in 10%, 10 year or 10. Then you can divide 10 year or multiply by 10%. Here 120. So second building which was purchased after 1st April 2018, after 1st April 18, that means 20 and 21, that is for either 20 years or 5%. So 20 years mean from start in 2021, so it will go to 2040 and 41, therefore we can take that. So here you can take 200. So altogether this is the total capital allowance relevant to that adjustment, right? So you can calculate. So we'll see. So altogether 2300. This is the total capital allowance. So let's say in your exam, the examiner given the adjustment like this. So this asset type given, and they have given the profit before tax. So let's say they have given the profit before tax. The profit before tax, let's say in this case 1700 rupees in 1000, and same time they have given the account in depreciation. So account in depreciation, let's say 600. Account in depreciation, let's say 600, right? Sorry, 1600. So my dear students, now account in depreciation for tax purpose is not an allowable expense. If it is not an allowable expense, what you need to do? The account in depreciation. So account in depreciation, you have to add back 1600, because when you calculate this 1700, that 1600 already deducted, therefore you have to add back. Instead of that, you can take what? The capital allowance. That is the specific way of calculate the depreciation for tax purpose, we called as the capital allowances. How much that? You can take 2300 as expense. So this is the way you have to adjust this adjustment, right? Here 3300, here 2300 minus, then you can see the balance is 1000. That is what? Assessable income from business, right? This is the way you have to do the adjustment. Please keep in mind the account in depreciation is never allowed to deduct as an expense for tax purpose. Never allowed to deduct as an expense for tax purpose. So this is the theoretical explanation how we can do these capital allowances as per section 16. So section 16 not all about the capital allowance. Can you remember there was another one? That is what? Balance in allowance. The balance in allowance. So then I will explain what is the balance in allowance, then how to calculate that quickly, right? How we can do that.